President Trump indicates a 10% tariff could be placed on China from the 1st of February. New Zealand's domestic inflation slows more than expected, and Malaysia holds rates amid strong growth. That's coming up in our 5 Things in 5 minutes. And then in today's bonus deep dive interview, ANZ Economist Henry Russell reviews the state of New Zealand's housing market and what to expect over 2025.
We are actually likely to see stronger sales activity, but it's working against a backlog of stock on the market, and that excess stock is likely to take some time before it is cleared.
But first, in 5 and 5 with ANZ, US stocks rose overnight as investor confidence in the economic growth path under the new Trump administration improved. At 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.8%, while Treasury yields also gained slightly, rising 1 to 3 basis points. President Trump overnight suggested a tariff of 10% could be placed on Chinese goods from the 1st of February. He also singled out the US trade deficit with the European Union. ANZ head of G3 Economics Brian Martin says from London that anxieties remain on what the near-term path for tariffs might be.
The fact that they weren't introduced on day one is generating some hope, possibly, that Trump will be a bit more cautious in how he approaches the whole tariff argument. But nonetheless, the intent is very much there. Trump wants to see a significant and very swift improvement in support to try and stop illegal immigration into the United States and the fentanyl problem. So possibly were you to get moves, foreign governments supporting Trump's aims in that direction, that may well appease some of the tariff anxiety.
As of 4 a.m. Sydney Melbourne time, the US dollar index was up 0.22%, the Aussie dollar down 0.03% at 62.73 US cents, and the Kiwi down 0.23% at 56.65 US cents. Number 2. New Zealand's headline inflation rate in the December quarter came in as expected by ANZ Research at 2.2% annually, the same as in the third quarter. ANZ senior economist Miles Workman says that under the hood, though, there were positive signs as annual non-tradable inflation was 4.5%, less than the 4.7% expected.
Now, stepping back, in absolute terms, it's still too high. The RBNZ need this to stabilise at around 3% year on year to call it consistent with medium-term inflation being stable at about 2% over the longer run. But ultimately, it does show that monetary or tight monetary conditions are doing exactly what you would expect them to do, what they say on the tin, and that's causing the domestic side of the inflation impulse to come back somewhat.
Number 3. The Reserve Bank of New Zealand had been forecasting a headline number of 2.1%. But Miles says that the lower domestic non-tradable inflation, as well as declining core inflation, should give it some comfort ahead of its February rate decision.
That surprise to their forecast has been driven by the volatile side of the CPI basket, the tradables side. That's always going to be a hard one to forecast. It's always more volatile than we can reasonably forecast. And I think given the evidence of underlying disinflation in the less volatile parts of the CPI, I think the Reserve Bank could actually look at the Q4 data and conclude that the disinflation trajectory remains well intact, and it certainly doesn't represent any roadblocks to a 50 basis point cut in February.
Number 4. Malaysia's central bank kept rates on hold yesterday at 3%. As expected, ANZ economist Arindam Chakraborty says it looks like Bank Negara Malaysia will be able to keep rates the same through 2025.
BNM expects broad-based strength in economic activity in 2025, and inflation is likely to be manageable owing to the absence of excessive domestic demand pressures. BNM also acknowledged the rise in ringgit volatility, but held the view that the currency will remain supported by narrowing interest rate differentials between Malaysia and other advanced economies.
Number 5. Singapore's headline inflation rate is forecast to have fallen from 1.6% to 1.5% in December. ANZ head of Asia Research Koon Goh says the important core measure is expected to fall from 1.9% to 1.6%, paving the way for policy easing by the Monetary Authority of Singapore this month.
That indicates continuation of the decline in inflation pressures being experienced in the city-state. A lot of that is thanks to the strong Singapore dollar and very favourable global commodity prices, given that Singapore imports a lot of its requirements and needs. The strong Sing dollar has helped to push import prices down, which is why we've seen a fall in overall core inflation measures.
Koon Goh there. Now, in today's deep dive interview, ANZ economist Henry Russell reviews the state of New Zealand's housing market after December figures from the Real Estate Institute showed a lift in prices.
The December housing market snapshot provided further confirmation that the housing market is now stabilising, with house prices rising for the second month on the trot, and in fact for the third month of the last 4. That's not to say we're seeing particularly large increases, but certainly we do expect this to pave the way for a gradual recovery over 2025. But ultimately, in order to get for a meaningful upswing in prices, that's likely to wait until the second half of the year once the adjustment in the labour market has occurred, which is still responding to past weakness in the economy.
There still seem to be some differences between the major centres. Can you just take us through those, particularly Auckland and Wellington?
Yeah, Wellington ended 2024 as New Zealand's worst performing housing market, with prices down 4.8% over the year. Look, that's potentially a reflection of the fact that public job losses are weighing on household confidence, and that's what we have seen in our ANZ Consumer Confidence Survey as well, where the recovery in consumer confidence has lagged the rest of the country. Auckland's housing market still remains fairly soft too, with prices down, finishing a year down around 2%, but relative to Wellington's housing market, where prices have been in decline for 9 months straight, Auckland's market is now starting to show a few signs of life.
Just looking at sales numbers in December, down nearly 12% seasonally adjusted in the month. You don't seem too concerned about that though. Just take us through that.
Yeah, so what we have tended to see over the past few months is that sales volumes have been typically underreported in the initial month and then revised higher over subsequent months. Given how sharp the decline was in seasonally adjusted terms, that's potentially a reflection of the revisions are likely in the coming months, particularly given the timing of December with holidays at the end of the month potentially disrupting the reporting of sales. And so we'll be watching in January's data to see if we do see an upward revision, but even saying that, given typical volatility from month to month, if we kind of look through that and look at the broader trend, sales have been trending higher since around August last year.
Days to sell rose 3 days to 50. Is there any concern there?
Again, that potentially reflects typical monthly volatility. If you smooth through the past 3 months, the median number of days to sell has stabilised at 48 days. Look, that's still a long way above the long-run historic average of 39 and does point to a still soft market. That 3-month average has been stable for the past 3 months, and we'd expect that does indicate to us that we're seeing a plateau there, and that's what we're seeing broadly across most housing market indicators, that there is a stabilisation occurring, and that is likely to pave the way for a gradual recovery into 2025.
And so do you see, I guess, prices on the one hand, but you've got days to sell, inventories, sales figures. How long do you think they'll take to return to normal over the year?
So a big handbrake on the recovery in the housing market that's still in place is that New Zealand's labour market continues to weaken. It's still responding to past weakness in the economy. And on our current forecasts, we expect the unemployment rate will continue to rise until the middle of 2025 and this year. And that's likely to continue to weigh on household confidence to borrow and to purchase housing. And so when we think about the housing market getting back to a more normal level of activity, we do anticipate that we won't see a meaningful improvement until the second half of this year. But in saying that, the number of properties being sold or sales volumes are actually running around their typical historic average. But the reason that we're not seeing that in kind of a normal response in prices is that hasn't been occurring for the past 2 years, and we've seen a significant increase in the number of houses sitting on the market due to past weakness in sales. So we are actually likely to see stronger sales activity, but it's working against a backlog of stock on the market, and that excess stock is likely to take some time before it is cleared. And as such, the recovery in the housing market is likely to be more gradual over the first 6 months of this year before we start to see a more meaningful upswing in the second half of the year.
Henry Russell there talking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, January the 23rd. Catch you tomorrow as we look ahead to the Bank of Japan's live rate decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.